Hello again, everybody. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, April 21st, 2024. Today, I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions. That is, when to be on offense, looking for opportunities, and when to be playing defense and protecting your capital. After studying the markets for over 40 years, I have learned that you can most definitely time the markets. There are times when it's more difficult to do so than other times, but it can be done with an unemotional, data-driven, and repeatable approach that follows the money rather than trying to forecast the future. Asbury Research provides investment research services and money management to individual and professional investors. We've been around since 2005. For more information about us, visit asburyresearch.com and use the contact tab or just click the link in the description of this video. Finally, if these videos are useful to you and you'd like to see more of them, please like and subscribe. It helps us to get in front of more people just like you. Now, let's follow the money by identifying some key areas of our focus as we look forward over the next 1 to several weeks. Number one, Asbury Research tactical models, specifically the Asbury 6. In our previous April 7th Follow the Money, we said that the Asbury 6 risk management model remained on a February 7th positive status. The S&P 500 had risen by as much as 5.4% since then. However, the A6 turned negative or bearish 3 days later on April 10th. We'll take a look at that in just a moment. And the benchmark S&P since then has declined by 4%. So let's go into the research center here by clicking the orange kind of hamburger looking button up here. And now we're in the research center, password protected, but we'll look at some of the tools that we have inside the research center today. So here's the A6. This is updated through the close on Friday, and you can see negative as of April the 10th. It turned negative as of the close on April the 10th because 4 or more of these constituent metrics had turned red or negative. So if you look at these a little bit closer, you can see that there are numbers in here. Those are the dates that each of these Asbury 6 constituents turned to negative or turned red. You can see the earliest one, the rate of change in the S&P 500, turned on April the 1st. But then we had a lot of activity around here around the 10th and the 11th and the 12th. That's when we really started to turn the corner in terms of the internal strength of the market getting weaker. What are the Asbury 6? Well, they're the rate of change in the S&P 500. That's the only one, by the way, that has a direct association with the S&P 500. When we built the A6, we wanted to get it away from just chasing the tail of the S&P 500. So the other ones are the relative performance of stocks versus high yield bonds, investor asset flows and SPY, volatility, trading volume, and market breadth. The Asbury 6 was created, let's go back here to where we were. The Asbury 6 was created to provide a data-driven daily indication of the true internal health of the stock market. There's so much noise in the market right now. It's really been here for well over 5 years. There's a lot more algorithmic trading going on. There's a lot more computerized trading in general that's going on. By some accounts, 80% or more of the daily volume is this algorithmic trading, computers trading with each other. And oftentimes it seems like they try to get us off sides, maybe push the market down for a couple of days, forces out of our long position, and then before you know it, 2 days later, we're making all-time highs. It forces us back in the market, but buying at a higher price. The purpose of the A6 is to help prevent us from doing that, from making those trading and investing mistakes due to all the day-to-day volatility, which has forced all of us, myself included, and I've been doing this for 40-some years, to make these emotionally driven trading mistakes. We've all done it. The Asbury 6 is updated every day, about 2 hours after the close, and it's available via the Research Center. So if you just want to take a little closer look here, you can see here's November 2nd, and the Asbury 6 is went to risk on, or it went to positive. Risk on is the term that we use for the correction protection model, or the CPM, which we're going to discuss in a minute, but we're not going to look at it today. But here you can see from November 2nd, turned green, it went to positive, and then January was a choppy month in terms of what was going on underneath the hood of the market. There was a lot of consternation. You saw it in the VIX, you saw it in asset flows, you saw it in volume. Then finally on February the 7th, this is called blinking, by the way, and it's when the market's at a balance point. It will show up in the Asbury 6. Once it gets over the balance point, the next extended trend typically begins. That's what we had on February 7th. And you can see that we stayed green or positive until April the 10th, and we've avoided all of this. So our second tactical model, which we're just going to touch on, this is meant to be an indicator rather than a model. Our second tactical model, the correction protection model, or the CPM, has also recently shifted to a risk-off status after being risk-on since November the 2nd. It didn't have all this noise in the middle that we had in the A6 because it's a much more sensitive tool. It's meant to do a different job. But the CPM is our wealth preservation model, which has historically closely mirrored the S&P 500 over the past 6 or 7 years, but with a lot less risk in terms of maximum drawdown, standard deviation, beta, things of that nature. If you're interested in finding out more, I'm not going to go through it today, but if you go up to models here and go down and select the model that you want, there is a lot more background information and charts about all of our models. Number two, sector rotation. You may be familiar with our CEIF model, which is also located in the research center. You can see our CEIF model is here. In our previous April 7th Follow the Money podcast, we said that the two top ranked sectors in our model were energy and industrials. Energy and industrials both remain on a favored ranking. And since then, since XLE and XLI showed up as top-ranked sectors on our model, XLE has outperformed the S&P by 7.9%. Let's call it 8%. And XLI has outperformed SPY by 1.7%. By the way, there's also there's a third favored ranking in the CEIF model this week. Subscribers can access it by going to the research center, which is where we are, and just going down and clicking CEIF. But what I wanted to focus on today is how does the model work? What does the model do? And what it does is, here's our energy. This is called a rainbow chart. These are the accompanying charts of the CEIF model. And all these charts do is they show the daily signals in the CEIF model for all of the 11 sector spiders, and it shows if they're on a favored ranking, which is green, a neutral ranking, which is yellow, or an avoid ranking, which is red. So when they're favored, you want to be buying those sectors, looking for both outright strength and relative outperformance. And when we're on an avoid status, you want to be out of those sectors. You don't want to be in those sectors because that's where the money's coming from. Here's where the money's going in the green, and here's where the money's coming from in the red. So you can just see, just kind of by looking at this over the past year, excuse me, this is April through basically July of last year, you can see energy was buried in the avoid ranking, avoid status, let's call it. And look what happened down here with the relative performance chart. XLE underperformed SPY during this whole period. Then we spent most of the second half of the summer last year, energy spent it up in favored territory, and look what happened, outperformance. And then we had this long extended period, basically from about a week before Thanksgiving up until the beginning of March, and all this underperformance that we had coinciding. Why? Because the money was going out of the CEIF model. The CEIF model, by the way, it tracks asset flows in the 11 sector spiders, the velocity of asset flows, I should say, in the 11 sector spiders in 3 different time frames. But look what's happened since March 13th when energy moved back up into favored status. We've got a 10% period of relative outperformance by energy. So all we're doing here is we're following the money. We're not trying to predict what the Fed's going to do or what's going to happen in Congress. All we're doing is we want to go where the money's going and stay with that trend as long as the money stays there. Look at our second one here. This is industrials. It's a little choppier, right? You don't have those clean lines like you do in XLE, but basically, with just a couple of exceptions here, in the latter part of February, February 23rd, XLI moved to a favored ranking. We had a couple of dips here in March 14th and 20th, where it dropped into neutral territory, but it didn't stay there for that long. And now it's back up in favored territory, and it's been there for weeks. Look what's happened corresponding down here in the relative performance relative performance chart, rather. XLI has outperformed SPY, the S&P 500, by 3%. So that's what we're looking at when we're talking about these trades. ETF ideas. Let's just move quickly through some of the ETF ideas because I mentioned them the last time I was with you 2 weeks ago. On April 7th, we said that we were long. We have another model here. It's a sector and industry group ideas. There's some performance data too here in this square. But basically, we talked about being long home builders. XOP, home builders is XHB, S&P, oil and gas exploration, XOP, and silver and metal miners. Home builders, we closed that trade out on 410 for 6% outright gain, 5% relative outperformance versus the S&P. A couple of days later, on April the 12th, we closed out our XOP for a 7% outright gain, outperformed the S&P by 7%. And then finally, on the 16th, which is just a few days ago, we closed out our long slash overweight idea in silver and metal miners, SLVP, for a 12% outright gain, 17% relative outperformance versus the S&P. Why did all these trades come off? Because the market itself weakened. The stock market itself got weaker. And it's probably, or at least according to seasonality, let's say, it looks like it's got some vulnerability to even getting weaker in the upcoming weeks. Let's look at some seasonality. So here's our seasonality chart. This is a quarterly seasonality chart. The data goes back to 1957. And these 13 columns are the 13 weeks of the second quarter of the year in the S&P 500 based on data that goes back to 1957. What we see here is the first 3 weeks of April are the fourth, third, and first strongest weeks of the year according to seasonality. The third week of April ended on Friday. From there, you see the rest of this period is pretty weak and it accelerates into the end of the quarter. The last 3 weeks of June are the 12th, 10th, and 13 weakest weeks of the entire quarter. So I look at seasonality as more of either a headwind or a tailwind for the market rather than a tradable signal. But considering what we're seeing, a lot of our trades in our sector and industry group table were closed out. We're moving into energy. Our CEF model actually aggressively moved out of technology last week, and we see that the Asbury 6 has also turned red. So all of these things indicate kind of a warning signal that there's going to be more weakness to come here. So that's what we're looking at. So that wraps up. Let's get back here. If any of you want to find us, we're at asburyresearch.com. That wraps up another Asbury Research Follow the Money podcast. Our next Follow the Money podcast is tentatively scheduled 2 weeks from today on Sunday, May the 5th. Have a great rest of your April, and we hope to see you again here soon. Please don't forget to like and subscribe. Have a nice Sunday.